Governments manage vital assets, roads, schools, hospitals for the public good. These assets are essential for delivering services to citizens. Sometimes their value drops, a loss known as impairment. Accurately accounting for impairment is crucial for trustworthy financial reports. This supports public trust and responsible management of taxpayer money. International Public Sector Accounting Standards, or IPSAS, guide governments in preparing financial statements. IPSAS 21 specifically addresses impairment of non-cash generating assets. This standard ensures government reports reflect true economic reality. Overstated assets can lead to poor decisions and mislead stakeholders. IPSAS 21 requires realistic asset valuations, improving decision-making. Understanding this standard is essential for public sector accountants, auditors, and policymakers. It ensures consistency and comparability in financial statements across governments and over time. Reliable information supports better governance and accountability. Transparent reporting allows citizens to scrutinize how public funds are managed. This script will break down IPSAS 21 in simple terms. We'll explain what impairment means for government assets. You'll learn how to identify and measure impairments. We'll highlight the importance of transparency and the benefits of applying IPSAS 21. The goal, a clear understanding of this key accounting standard. With this knowledge, stakeholders can better interpret public financial information and hold governments accountable. IPSAS 21 is an accounting rule for public sector bodies, titled Impairment of Non-Cash Generating Assets. Issued by the International Public Sector Accounting Standards Board, it aims to prevent overstatement of asset values. The standard provides a framework for recognizing and measuring impairment losses. It prescribes how to determine if a non-cash generating asset is impaired and how to measure and recognize any loss. IPSAS 21 also covers when to reverse impairment losses and what disclosures are required. These disclosures help users understand the impact of impairments on government finances. The standard applies to all levels of government and their agencies. It focuses on assets held to provide services, not to generate profit. Examples include public parks, defense equipment, and heritage sites. Before IPSAS 21, governments treated impairments inconsistently, making comparisons difficult. The standard brings rigor and consistency to public sector accounting. It ensures financial statements faithfully represent asset values. This is crucial for accountability and sound economic decisions. By applying IPSAS 21, governments present a more accurate financial position. This helps policymakers, auditors, and citizens assess the true health of public finances. Consistent standards also improve international comparability. Reliable reporting supports better governance and resource allocation. IPSAS 21 is a cornerstone for transparent, responsible public finance management. Impairment means an asset's value has dropped significantly, not just a minor temporary dip. An asset is impaired if its carrying amount exceeds its recoverable service amount. Carrying amount is the asset's cost minus depreciation and previous impairments. Recoverable service amount is the higher of fair value less costs to sell, or value in use. For non-cash generating assets, value in use is about remaining service potential, not future cash flows. This could be measured by replacement cost or the present value of remaining service capacity. Recognizing impairment ensures financial statements reflect economic reality. Overstated assets can mislead decision makers and delay necessary maintenance or replacement. Impairment is different from routine depreciation, which reflects normal wear and tear. Impairment is a sudden, significant decline in service potential, often due to specific events. For example, new technology might make an asset obsolete faster than expected. Recognizing impairment loss keeps financial reports honest. This distinction is vital for accurate public sector accounting. Public sector entities own many non-cash generating assets. Schools, roads, hospitals, parks. These assets exist to provide public services, not to make a profit. Their value lies in their service potential, the ability to deliver education, healthcare, transportation, recreation. Assessing impairment for these assets is unique because their worth isn't tied to revenue generation. For example, a school's value is its capacity to educate, not its market price. A decline in service potential due to damage or obsolescence signals impairment. IPSAS 21 addresses these assets because their impairment indicators and measurement methods differ from cash-generating assets. For non-cash generating assets, impairment might be triggered by reduced demand for services or physical damage. Recognizing this distinction ensures appropriate accounting treatment. Governments invest heavily in infrastructure and public facilities. Properly accounting for impairments is vital for transparency. It helps citizens and oversight bodies understand how public resources are managed. Accurate reporting supports trust and accountability. This clarity is essential for effective public sector governance. Government assets lose value for many reasons. Physical damage, like a library hit by an earthquake, can drastically reduce service potential. Technological obsolescence is another factor. Outdated systems may become inefficient or costly to maintain. Policy changes can also trigger impairment, such as when a specialized facility loses its purpose. If an asset can't be repurposed or its value drops for alternative uses, impairment must be recognized. A long-term drop in demand for an asset's services, like a toll road losing traffic to a new highway, can also indicate impairment. These scenarios reflect the economic reality of diminished utility. IPSAS 21 ensures such losses are recognized promptly. This prevents overstating asset values and supports responsible management. Timely recognition of impairment helps governments make better decisions. It also signals to stakeholders that public resources are being managed transparently. Addressing impairment is key to maintaining public trust. IPSAS 21 requires regular assessment of assets for impairment. At each reporting date, entities must check for signs of impairment. This isn't just annual. Significant changes during the year also trigger reassessment. The standard lists external and internal indicators as triggers. External indicators include a sharp decline in market value or adverse changes in the environment. Internal indicators involve physical damage or changes in how an asset is used. For example, closing a hospital wing or fire damage to a school are clear signs. If any indicator exists, the entity estimates the asset's recoverable service amount. If there are no signs, no full impairment test is needed. This targeted approach keeps the process efficient. The focus is on assets with genuine risk of value loss. Systematic assessment ensures impairments aren't overlooked. This process underpins reliable, transparent financial reporting. Once impairment is indicated, the next step is to measure the loss. The recoverable service amount is the higher of fair value less costs to sell or value in use. For non-cash generating assets, value in use often means the present value of remaining service potential. The depreciated replacement cost approach estimates what it would cost to replace the asset's service capacity, adjusted for age and condition. The restoration cost approach subtracts repair costs from replacement value. The service units approach measures reduced capacity, like a bridge that can now handle fewer vehicles. The chosen method depends on the asset and available data. If recoverable service amount is less than carrying amount, an impairment loss is recognized. The loss is the difference between these amounts. It must be recorded immediately in the financial statements. The asset's carrying amount is reduced to its recoverable service amount. This ensures assets aren't overstated on the balance sheet. Accurate measurement supports sound financial management. Applying IPSAS 21 boosts transparency in public sector reporting. Recognizing impairment losses means governments openly acknowledge when assets lose value. This honesty gives citizens and stakeholders a true picture of public finances. Transparent reporting leads to greater accountability. Stakeholders can question why assets lost value and how to prevent future losses. IPSAS 21 promotes consistency across entities and over time, making comparisons easier. Reliable, comparable information is vital for oversight and informed decision-making. Accurate asset values improve the credibility of financial statements. This strengthens public trust in government institutions. When citizens trust financial information, confidence in public management grows. Transparency is the foundation of good governance. IPSAS 21 helps build that foundation. Consistent use of IPSAS 21 brings lasting benefits to public finance management. Accurate asset values support better decision-making about maintenance, replacement, or disposal. This leads to more efficient use of public resources and prevents waste. Knowing the true condition of assets helps governments plan investments wisely. IPSAS 21 encourages proactive asset management and fiscal discipline. Regular impairment assessments discourage neglect and promote timely interventions. Transparent reporting makes it harder to hide poor management. Adhering to IPSAS 21 enhances credibility with citizens and international partners. It can improve access to funding and boost credit ratings. Most importantly, it reassures the public that resources are managed responsibly. Strong, transparent accounting standards build resilient public finances.